Hello, Finimizers. Welcome to another Finimize live event. My name is Stefan, the global markets analyst here at Finimize, and I'm very happy and excited to host today's event on how to build your passive income playbook with our partner, Heron. So first, we have some basic housekeeping rules to go through. So number one, as you're coming in, please fill out the poll so we can get to know you a little better. It should appear very soon. Feel free to introduce yourself in the chat, tell us where you're tuning in from, and remember to switch to all attendees so everyone can see your messages. In terms of format, it's going to be a 15-minute discussion followed by a 15-minute Q&A. So, use the Q&A box to ask a question. And if you see a question you like, just upvote it so it moves to the top. And, that way we can get through the most upvoted questions first. All right, so let's kick this off. So Heron Finance provides US accredited investors access to private credit by building personalized private credit portfolios based on an individual's risk profile and investment objectives. At the heart of Heron's expertise is their private credit scoring model, where they sift through thousands of data points to identify the best of the best of the best funds. Using the highest quality funds, Heron then provides investors with exposure to 1,000 of loans all in one portfolio to simplify investing. So today, I'm super excited to have Khang Nguyen, a Chief Credit Officer at Heron. Khang is the Chief Credit Officer at Heron. As I just said, in his role, he shapes the company's credit vision and strategy, and he oversees all aspects of credit research, underwriting, and risk management. Before that, he helped scale multiple fintech startups, launching innovative credit products, and securing over 700 million in funding. With a decade of experience in institutional lending and investing, he's structured and advised on 20 billion worth in transactions across direct lending, asset-based finance, and special situation. And if that wasn't enough to impress you, well, just know that he holds a degree from Princeton University. So, you are in very good hands today. Khang, great to see you here. How are you doing today?
I'm doing great. Thank you. Thanks for the very generous introduction.
All right, let's dive in because this is quite a cool and interesting topic. So to start with, can you maybe just define private credit for our audience, trying to keep it as simple as possible? What exactly does it involve? How does it work? Please, tell us the gist of it.
Absolutely. So let's jump right in. So private credit is an asset class that primarily involves privately negotiated loans. So these are loans that are made by non-bank lenders, such as private credit firms. They do not trade on a national exchange. One way that you can understand private credit is to look at how equity is labeled, right? So you have public equity, you have private equity. Public equity, like a stock, you can buy on your mobile app. And then you have private equity, that's where companies are owned by private equity firms. So same way for credit, you have public credit such as high yield bonds. Then you have private credits such as middle market loans that are made by private credit firms. One final note on this. So when you talk about public credit, you typically refer to broadly syndicated loans or corporate bonds that are often underwritten by banks like Goldman Sachs and JP Morgan, and they're usually rated by an agency like a Moody's or S&P. Private credit, on the other hand, is originated by and managed by private credit firms like Apollo or Ares, and is typically not rated.
I think, there are a lot of misconceptions about private credit. So can you maybe bust some myth around it?
Yeah, so yes, there are quite a few. Having been in the industry since GFC, I must say that as an industry, we can do a better job at dispelling myths about this asset class. So I'll start with three misconceptions that I see quite a bit in my work, in my conversation with investors about private credit. And really, my hope is that by the end of this half an hour, you all will walk away with a clear understanding of what private credit is not. So let's talk about three of those misconceptions. One is private credit is a hot asset class that promises sky-high returns. Second is that private credit is inherently risky. And number three, private credit is a new and unproven strategy. So first one, private credit is a hot asset class that promises sky-high returns. So this could not be further from the truth. Yes, private credit offers attractive, stable yields, but it's not really designed to deliver outsized returns, at least not consistently. That's the key word, right? Not consistently. So taking direct lending, for example, this is by far the largest segment within private credit strategy, within private credit industry, and really where we have the most historical data. So the average return has mostly been in the 9 to 13% annually for direct lending, which is the bulk of private credit industry. At Heron, we do track most of the largest direct lending funds, and our data shows that it doesn't matter how far back you go, 10 years ago, 15 years ago, 20 years ago, the annualized total return of some of the most experienced and largest private credit managers out there has largely fallen in this very narrow range over time. So there are other segments of private credit as well, such as distressed debt, where you can potentially generate mid to high teen returns. But that particular strategy tends to be more cyclical than direct lending, which tends to be more predictable, if not boring. And that's a good thing as far as credit investments are concerned. And so if 9 to 13% annually is what some of the best in the industry deliver on a consistent basis, if you hear people promise you 15 to 18% net return, a year consistently, you should be mindful of the risks that come with that kind of investments. You should be asking questions like, are you taking actually equity risks? Who's the manager behind a portfolio that promises that kind of returns? Does that manager have $20 million in AUM or 20 bill or $200 billion, right? Have they been doing this for a long time? Are they positioned to navigate a downside scenario? So it's not that mid to high teen returns annually are unachievable in private credit. It's just that no one has really been able to do that at scale and consistently year after year. So the bottom line is that private credit isn't a high risk, high return kind of investment as compared to venture capital or private equity. However, it does make sense, in my opinion, as a reliable, high quality, high income kind of investment. And maybe the second misconception is private credit is inherently risky. So yes, there's this notion that private credit is risky simply because it involves lending to private companies. But let's break it down a little bit and see who the main players are. So first of all, most of the players are large institutional investment firms. These are firms with tens of to hundreds of billions of dollars in AUM. They have hundreds and in many cases thousands of employees across multiple offices. They have in-house teams that do all kinds of structuring and deal monitoring and loan servicing and workouts and whatnot. It's also very, very important to note that the typical US corporate borrower in private credit, these are large scale established enterprises that are mostly backed by private equity firms. Well, based on the data that we track, the typical corporate borrower in the US generates more than $100 million a year in profits. So that a few hundred mil in annual revenue, right? So that's an average corporate borrower for private credit. So this is not small-sized companies with limited, operating history. We're talking about, as far as direct lending is concerned, we're talking about very established companies that have been in business for decades, if you will. So maybe another misconception, just to finish up this point.
Khang, sorry to interrupt, but
Yeah.
I'll take on your offer that you told me just before the interview that I have to cut you off.
Please.
Just
Okay.
mindful of time because we have 4 minutes
Yeah.
left. So in 1 minute, the last point,
Yes.
please.
Yeah, 1 minute. Okay, so the 1 minute is that private credit is new and unproven strategy. So Not true. Private credit has really been around since the 90s. In fact, on Heron, we have two managers that have been doing this since the early 90s. So this has been, around for a long time, just that we hear a lot more recently. So to really conclude, right, private credit is not a hot asset class that delivers sky-high return consistently. Private credit, just because it's private doesn't mean it is an inherently risky. And number three, private credit is actually not a new or an improvement strategy. So
Son, thank you so much. So many
yeah.
see private credit as just another alternative asset, but why should it be viewed primarily as an income generating strategy?
Yeah, so I personally find the categorization of private credit as alt quite confusing, actually, and that at least not helpful. I mean, we're talking about just lending, right? So to me, just because the same company does a private credit deal versus a bank-led, bond issuance shouldn't significantly alter how we view the nature of these credit investments. So I think what's important to think about is that for private credit, because of its profile as a high income generator and very low loss rate, talk about like 1% on average a year for the whole industry. If you do your diligence, you pick the best manager, you should expect the loss rate to be a lot lower than 1%. And so if you assume a lot of, the audience here is very familiar with, the 60/40 portfolio, right? Where, you really, people use a loan fund or a bond fund as a source of income. Well, historically, those asset classes have delivered about, 4 or 5% a year, again, over time. Private credit has delivered twice as much. You talk about, 9 to low teen returns annually. So to me, given the fact that it is not as volatile, it has low correlation, it has a lot higher return and higher income potential and very low loss rate, mostly because of a high recovery rate in a default scenario. To me, it makes a lot of sense as a income strategy as opposed to just an alt. To me, alt is more like what you probably know very well, Stefan, just like macro trading, right? I mean, those are actually more alts, right? As opposed to private credit to me, it's just lending. So,
And last question, maybe to bring it even more to life. Can you maybe share an example of how your strategy has helped investors generate stable income?
sure, yeah. So we only offer our clients, the highest quality of, private credit investments. So in terms of both consistent income and low losses, so at Heron, we score and we rank every single fund that we work with. I mean, to date, we've scored private credit funds that are managed by firms with about $1.5 trillion in aggregate private credits, AUM. That's about 90% of the industry, right? We have built a proprietary scoring model so that combines rigorous fundamental analysis, credit analysis with our data advantage as a tech company, basically, to screen for the highest quality private credit funds. So there are two steps in the process. Step one is make sure that the fund passes our hurdle in terms of minimum quality, and number two, which is more a relative value argument here, which is for all the funds that score the same in terms of risk, we pick the ones with the highest returns or potential to generate returns in the next 12 to 18 months. So as a result, we end up with high quality funds that are also well managed and with portfolios that are very well diversified, with a defensive portfolio construction, and we believe that these are portfolios that are well positioned to perform in this particular market environment, which looks pretty depressing if you look at the stock market, right? But maybe this is a good time for us to talk about private credit. So right now, we just finished our Q4 update because some of the funds release earnings quite late. But right now, the average high quality fund in our portfolio looks like the following. So I'm going to share with you a few key metrics. 0.4% in PIK, meaning I'm sorry, 4% in PIK, meaning of all the income that the fund generates, less than 5% is PIK. And PIK, as you know, which is payment in kind, is an indicator of risk. 0.4% in non-accrual, so that less than 1% in non-accrual. Non-accrual does not mean loss, by the way. If because of the fact that most of these are first lien loans, even if these loans were in default, you should expect the average recovery rate to be about 70% of principal. 92% of the portfolio is first lien loans. Again, first lien, high recovery in a default scenario, all else equal. And in terms of return, we're looking at about 11 or so percent in total return annually, and the loss rate is 0.1%. Again, 0.1% loss rate annually for these funds that we're offering to clients.
This is quite impressive. Thank you so much, Khang, for all of those great and super clear explanations. So now we're going to move to the Q&A. So please, ask your questions in the Q&A box, and make sure to upvote the questions you want to see answered first. So I'll just go through the list. So the first question, what is the risk of private credit? So maybe you can explain all the different types of risks.
Yeah, so there are a lot. First of all, is the lack of liquidity. So private credit assets do not trade on a national exchange like equities, right? Especially with respect to direct lending, which has been, really the largest strategy within private credit. These loans have multi-year duration, right? They don't self-amortize. So that is something that clients should be very careful when they look at private credit. Second, really important risk in private credit is these are hard to value assets. I mean, it is not uncommon for you to look at different private credit firms carrying different valuation marks on the same loan. Now, in many cases, they're not very far apart, but when you have a distressed scenario, if the same loan shows up in 5 different managers, you might get five different marks. So, well, because number one, among other reasons, number one, these are hard to value assets. Also, maybe different managers have different view about recovery, and maybe they have different, methods to value private credit loans. The relative lack of transparency is true. So private credit borrowers tend to be privately owned, in many cases, smaller size companies, at least as compared to public credit. Because these companies are not publicly listed, the information can be challenging to get all the information. This makes assessing credit quality challenging, and can really limit the extent of due diligence that can be conducted by the lenders in private credit. The other thing about private credit is that unlike, say, bonds, right, there is a high degree of deal structuring complexity, right? Unlike public credit, where the terms can be quite streamlined, private credit deals tend to be less standardized, more bespoke, and more tailored to the specific needs of the underlying borrowers. And so those unique structures can make private credit assets complex to evaluate, to monitor, to service, especially in the downside scenario. And speaking of servicing, right, there's a risk there, because if the deals are not streamlined, you really have to know the documents really, really well. You have to really know the underlying situation really well for you to be able to service the loans and be able to recover or identify issues before they become really, real issues. Maybe I'll end with this, with this note. It's still a pretty short history in terms of private credit. So yes, some of the funds have been around since the 90s, but still, 30 years, right? Private credit is still, since inception, we haven't actually seen a systemic correction or, correction. And it's had been like pretty smooth sailing since the beginning of the industry. So for what it's worth, that's something that investors should be very mindful. And so to us, it's really important, probably more important ever since inception of the industry, that a client should be focused on manager selection. They need to know who they're putting money in, because this is a time for dispersion, as opposed to the last 10 years would tend to be more of a beta play.
An important point. Is this available to investors outside the US?
Currently, it is not. Heron is currently not. However, there is an offering on the Goldfin Foundation where a non-US investor can access private credit. So if you go to, for non-US investor, if you go to goldfinch.finance, so goldfinch.finance is where non-US investor can get access. But that, but Heron's right now strictly is for US accredited investors.
Investors think of private credit as a direct replacement to bonds investing, and should they think similarly in terms of portfolio allocation to it? So two interesting questions in one.
Can you repeat that, Stefan?
So should we think of private credit as a direct replacement to bond investing? That's the first part of the question.
Not direct replacements in the sense that private credit is not freely tradable. And so I think if you care a little less about liquidity and you just want to focus on income, yes, it's a very compelling replacement for bonds. But if you are talking about, being able, to trade in and out of, then it is not. So if, I think the first question you want to ask yourself is, do you have a portion of your portfolio where like, I don't need to touch that money in the next 6 to 12 months? Okay, well then if that's the case and and you really want higher income, yeah, then replace that portion with private credit. But if you want to like put money in and then take it out in the next few weeks, then private credit is not for you. So.
And the second part of the question was how to think about like how would you allocate to private credit as a percentage of the portfolio, I guess.
Yeah, so that's a great question. To me, there's no such thing as the right percentage for everybody. I think it depends on who you are, what you need, in terms of what do you want out of this, right? So maybe I'll encourage you to think about allocation along 3 or 4 dimensions as follows. First, determine how much of the money you want um, to be in your liquid, bucket. Then that it would be like equity and bonds, right? But if you already have your your own resources in terms of cash, and you really want a portfolio that is blind to liquidity or lack thereof, then I would say like next question would be, okay, now that I'm okay with the lack of liquidity because I don't need that money until maybe next year, then the next question is, what is your yield focus? Meaning, do you have live expenses that need to be covered by? So for example, if you say, okay, I have 10K or 100K that I can put into my portfolio and I need to make, $100 to $1,000 a month, right? So if you have a view about yield, you can back solve for how much of your portfolio should be in yield orienting investments like private credit. So the second question or the second dimension is like how much income you want to generate out of this portfolio. Third is maybe from a top-down perspective, or maybe, what's your investing style? Do you like to be with the market, or you want to be trading with the market, or you feel like I'm done with the vol, it stresses me out, I don't want to deal with that. Okay, well then private credit makes more sense, right? Or maybe it's a matter of, staying away from equity for now because it's too volatile. Maybe you're bearish on the equity market for the next, 6 months or 12 months, and you just want to put most of your money in this set and forget, bucket, and you still generate, close to 10% yield a year. That's pretty decent, right? So to me, the right allocation to private credit is dependent on your answers to the questions of how much of the portfolio do you want to be converted into cash easily? Do you care about yield? And if so, how much? Do you have a view about other asset classes, such as equity or commodities, where you're bearish on those asset classes, therefore you want to put more of your money into something that is lower vol, lower low correlation kind of strategies like private credit. So I think you have to answer those questions first. And if you're like, hey, I don't like the public market, at least right now, is stressing me out. I would love to get 10% yield, which is twice as much historically as public market. And I don't need to get all to convert all of my cash, my portfolio into cash. Then private credit can be a very compelling option.
Thanks a lot. So next, I'll combine two questions in one because they're very similar. Is private credit investing for more like the long game? And could it play a role when thinking about retirement, for example?
So retirement, I assume that when you say retirement, it means that you want current income or passive income. This is perfectly the right. This is almost like it's like a high quality, high income strategy, if you will, right? So I think it fits actually really well into any scenario like retirement where you need a check to cover your expenses, right? So yes, and the first part of the question is I forgot the first part.
Yeah, so I think when thinking about retirement is more investing today for retirement in say 10 to 15 to 20 years.
Okay,
Should that be part of that long-term portfolio for your retirement?
Yeah, okay. I thought you say as a retiree. Okay, so I would say like there are very few asset classes that can consistently generate that kind of return. So private credit is boring, but in a good way. But remember, this is compounded interest, right? To me, it definitely should be a part of any long-term or even short-term strategy, because yes, equity is attractive, but in some years, they're not, right? If you look at equity return for the last, 10, 20, 30, it depends on which window you're picking. There are windows where private credit actually returns, the returns are actually more compelling in private credit than in equity. So to me, just to not miss out on this, asset class, which I think is great because it offers very low losses and low correlation with the overall market, I think it deserves a spot, at least not zero, right? Some allocation in a long-term strategy as well.
Thanks. And the next question is, you mentioned, you talked about liquidity as a risk previously. So could you maybe, explain a bit more? How does liquidity differ in private equity versus public equity market, in private equity markets versus public equity markets or debt?
Okay, so I would put, I think there are two broad categories, right? Liquid versus not liquid. Liquid meaning you can buy and sell on the app, like without worrying about the price distortion. And then non-liquid would be like really all the alts, right? Private equity, hedge funds, venture capital. So to me, private credit is really part of that less liquid asset class. But you can still invest in these semi-liquid vehicles that allow you to get some liquidity within a certain window. So with private credit, when I say like it's a less liquid asset class, it doesn't mean that you will not see your money in a few years, right? You get your money back, but it's not like the experience of buying and selling stock. You're on mute, Stefan.
Oh yeah, sorry. Typical. So I'm afraid that's all the time we have today. It's already past 6 or 5 in London, or I don't know, wherever you are. But thank you so much, Khang. That was incredibly insightful. Thank you so much. And thanks everyone for joining this event. As you leave today, a pop-up survey will appear on your screen. So, please take a few minutes to let us know what topics you're interested in. And thanks very much for joining us. Thanks again, Khang, and hopefully see you at our next event. Bye, everyone.
Same. Thanks, everyone. Bye.